Thank you very much for the introduction and welcome everybody to this panel on real estate debt. I'm joined by four operating experts who participate in the real estate debt markets every day. I'm going to ask each one of them to introduce themselves shortly. Our intention for today is to discuss, hopefully interactively with some of the audience, the characteristics of the real estate debt market, the changes that we're seeing in the market over the course of the pandemic, and looking forward into 2021. It's a very interesting time from a macro perspective. You know, we're in an environment of rising interest rates at this point. We've seen real estate asset values recover and increase quite significantly since the nadir of the market in the March-April time period last year. There is a wealth of alternatives for individuals and companies that are seeking to acquire and finance real estate today, both with balance sheet lenders, the public markets, the agency markets, et cetera. My colleagues on this panel are in the market every day, transacting and making choices and optimizing the way to structure real estate. And so I hope and expect we'll have a really robust discussion. I'd like to start out by giving each participant an opportunity to introduce themselves, hopefully for 60 seconds or so. Edward, maybe we could start with you.
Perfect. Good morning, everyone. Edward Corwin, go by EJ, with Federal Capital Partners located in the Washington, D.C. metro market. We are a real estate investment firm operating under a fund model, currently finishing up our fourth vehicle. We are predominantly multifamily, having acquired over 50,000 units during our lifetime. We also have a very targeted commercial office strategy in creative office space. We invest our capital both direct as an owner-operator through JV and via structured investments, which is the focus of this phone call. And we do that both on development and existing acquisition opportunities. We are nationwide. And for our sub-debt bucket, which kind of the focus of today with alternative strategies, we have both higher leverage, higher return capital, and more moderate leverage, lower return capital. And in all those cases, we can go behind the agencies, banks, life cos, and bridge lenders. Thank you very much, and passing on to the next panelist.
Thanks. Steve, over to you.
Morning, everyone. Steve Parinello, Pennybacker Capital. Pennybacker is an Austin, Texas-based private equity real estate firm. Formed in 2006. The firm does both debt and equity. We've raised 5 institutional equity funds that do JV equity and principal investing with the target of multifamily. Since inception, we've purchased about 26,000 units. In the Southeast US, Texas, and the Denver and Phoenix markets, focused on the middle market. So, we're targeting check sizes $5 to $25 million. And we've recently raised two credit funds. We're onto our second credit fund that's focused on special situation whole loans, sub-debt, both long and short duration. So we can go behind the agencies or CMBS, as well as banks and bridge lenders. So again, with a middle market focus, and we're doing business in a lot of same markets as our JV equity platform. On to the next person.
Great, thank you. Peter?
Hi, good morning, everyone. Peter Saganik with GTIS Partners, a fund manager based in New York. We manage about 4.7 billion of assets under management across about a dozen different funds. And we're mostly focused on new development, mostly in the Sun Belt and mostly residential, though not exclusively. We've been really active since the global financial crisis that created the distressed opportunity in residential that turned later into a large opportunity to develop assets. And since then, we have invested in about 4,000 multifamily units, about 5,000 single-family rentals, and nearly 25,000 homes and lots that are both for rent and for sale. And today we invest both through equity structures in joint ventures, as well as developing some of our own properties. And we invest in debt, mostly in a structured format, mezzanine construction loans and preferred equity in development projects, both single family and multifamily.
Thanks, Peter. Ted, last but not least.
Thank you very much. Good morning. Ted Van Brunt at RRA Capital, based here in Phoenix with an office also in New York. We are bridge lenders, kind of transitionary, mostly senior secured stuff, smaller balance, typically 5 to 15 million is where we compete the best. And we are nationwide. We do really all product types, willing to look at anything. And we've been around for about 12 years. We invest on behalf of an insurance SMA, and we also have our own closed-end fund. We're investing right now on our second closed-end vehicle. And yeah, that's about it.
Great. So as folks can see, the participants have a wealth of experience focused on the residential side of real estate. And I guess my first question, for discussion would be centered around the relative value of real estate fixed income compared to other investments in fixed income that are available for investors. We all have funds or exposure to real estate backed fixed income. There are various return parameters that I'm sure each entity manages to. It would be great to understand, how you all see the relative value from the perspective of somebody considering an investment in a real estate fixed income fund compared to high yield, compared to CMBS, compared to other alternatives. Peter, do you want to start there?
Sure. I just had a look this morning at the effective yields and estimated returns of the different asset classes, so I could bring some fresh data. And obviously, everyone knows the 10-year Treasury barely above 1% today. Avalanche of capital there. Investment grade corporate yield barely touching 2%. If you want to venture into corporate high yield, you may get a 4. If you are willing to go into real estate with CMBS, BBB bonds, somewhere around 4.5%, 5%. And so it starts being more interesting on the real estate side, but it's really a world of haves and have-nots, like everything during this pandemic and in recent years, because banks are so focused on PPP loans and they've just been told to increase their capital reserves. Where they are not putting money to work is, in our view, in the construction space on the real estate side. And we are seeing effective yields of between 12 and 15% on construction lending and mezzanine capital. Obviously, there are pitfalls there, and the market is very bifurcated. There's a lot of distress in hospitality and retail, not much at all in multifamily, and industrial is in fact doing better than before the pandemic. So clearly a big dispersion, but where we are seeing opportunities on both relative and absolute terms is actually in the more resilient sector like residential, and more on the construction side, where clearly demand exists for assets and for units with demographic growth, but there just isn't enough capital to supply the gap that banks have opened because of their reserve requirements recently.
So you've highlighted the fact that within U.S. real estate, there are sectors that are haves and sectors that are have-nots. Edward or Steve or Ted, any comments on the sectors that are most popular today and the sectors that are struggling in order to attract the capital stack that's required to execute a transaction?
I'll give a quick lead and then turn over. The obvious one that many of us play in and our firm's focused on is multifamily. Multifamily is kind of the darling right now. There is a tremendous wall of capital flowing into that space. Despite the concerns during the pandemic of delinquencies and non-payers, I think the multifamily space has held up tremendously well and attracted a lot of capital that has flown from other investment types. Is that creating a bubble? We can probably talk about that later, but that's definitely one of the haves. And we as a firm, and I'm sure others on this call, feel very comfortable in the space. We've been in a long time. We know it. We know the ins and outs, but the competition is definitely increasing.
Yeah, I mean, what I would say is, it's just specific to multifamily. In certain markets that we own assets in, we've looked to sell some assets, and the pricing we're seeing even from 90 days ago, could potentially be up 10 to 20%, right? And cap rate compression it's pretty unbelievable, and how quickly it's compressed even further. So, in the multifamily space, early on in the pandemic, what we saw on the credit side was the agencies dominated all, and we were doing some preferred equity behind them, and up till recently, where they've raised their pricing, and now we're seeing a lot of 3-year IO bridge loans for multifamily, where people are looking for pref or mezz above that. That's what we've seen. I think industrial's kind of been throughout the I'm curious what everyone else has seen, but throughout the pandemic, I think industrial's kind of just been, the same. If it's stabilized, the life cos, and/or banks dominate. And then if it's construction related, it seems like it's remained just extraordinarily tight for anything industrial construction, whether it's spec or, pre-leased, pre-sold. So we've seen that.
I would add kind of as a perspective, because we do multi here, but we get priced out of a lot of stuff because of where our cost of capital is right now, and where we're, the strategy we're trying to go towards. And so that's, we do some at the margins where we have preferred relationships, but we're seeing a lot of interesting stuff on the have-not side. When you look at kind of risk-adjusted pricing, I have to believe some of the hotel stuff we've been seeing recently, especially, really strong flags, good locations, kind of drive to leisure, that's going to come back really soon. We've got some of those in diligence where, they had a really tough January when COVID spiked, but February and March have been the best they've seen in, 18 months, and really excited about, and that the yields, you're able to achieve there are double kind of on just a coupon basis there for the same sort of, or lower LTV exposure as multi. And so I feel like, there's maybe more risk priced into something like hospitality, and maybe kind of multi's priced definitely closer to perfection. And then there's other property types in the middle there. I think we could talk about office and retail are more in the middle, but I would say on the other end of the barbell, we're starting to see some exciting hospitality.
Ted, you bring up a very interesting point that, multifamily is priced to perfection, as you say, and certainly, whereas perhaps a year ago, anybody looking to finance a multifamily asset, their first call would be to the agencies, to Fannie or Freddie. And today it seems that you have some pretty significant competition to the agencies and the life companies and others that provide financing. When you get away from the hot sectors, when you get away from industrial and multifamily, which are the two flavors du jour today, it becomes a little more interesting, particularly for debt funds like all the panelists operate. And how do you evaluate the risks and rewards, and how do you get to the right rate and structure when you're looking at a hotel financing or retail financing for an asset that may have been struggling, hopefully is rebounding, and yet undoubtedly has more risk than a multifamily loan?
Sure. I think for the hospitality, I mean, because we're in the early innings, I would say, of the recovery, we're going for down the fairway stuff. Like I said, strong flags, recent PIPs, recent construction, really good markets, strong leisure component, lots of resilient demand drivers. Because look, they're priced where they are for a reason. Historically, they've been very volatile, very susceptible to any downturns in the market, high operating expenses, et cetera. So our focus on anything that's kind of outside the box, not down the fairways, is this kind of still liquid even when things aren't going well? Can we get out of this? Are there still market participants that will take us out of this leverage point, even with a 20-30% decline in value? And those aren't easy. I'm not saying that we see these all the time. But again, especially in these early innings where there's still a lot of uncertainty about how the recovery is going to look, it's always, are there historically, how resilient is this cash flow? How resilient is this from an investor or lender takeout? And at the end of the day, could we operate this or find somebody to operate this for us to get through the tough times?
To all the panelists, are there in cases like that, are there structural elements that you put into loans to help protect yourself, via covenants, via debt service reserve funds, other structural elements that help protect you as the lender?
I guess I could start off on, for something like hospitality, we absolutely have significant seasonal reserves for one. We also put a long lead time in terms of interest reserve replenishment. Typically, if we're seeing by our own forecast, 6 to 12 months, if they're not going to be at least a 1.1, we require them to get going on replenishing that reserve earlier rather than later, before everyone's caught and can't find the cash when you need it. Just so we always have as long a lead time as we can structure, where we can start to resolve this situation and know sooner rather than later if things aren't going to plan. Cash is king in those respects. And so those are the most effective historically for us, not fancy, but the most effective.
How about on the multifamily side, Edward? I know you've been you've been financing a lot of your activity. Have you had various sources of financing? Have you relied on the agencies? Are you focused across the spectrum of lenders?
I think that's a great question. Thank you. We are, a large institutional multifamily operator, so we have access to a lot of the capital. We've always been a big agency borrower. We've got a nice stable of large banks that we work with. But what we saw during the pandemic is, with the credit contraction, some of the larger banks were a little bit immobilized. So we started working much more frequently with more regional banks, super regional banks, that had balance sheets that they wanted to expand. So that was kind of a new opportunity for us. And that also brings a little bit more of a localized focus where, we're going into markets, or we're active in markets, Southeast, Southwest, that have a much higher growth story. That's harder from some of the more national banks to understand, but the localized folks really understand that. So we've been able to, leverage our interest in investing in, we call them in-flight markets. I'm sure all of you know where the population's going, with a localized financing presence that's really knowledgeable in that base. We've started to work more with the debt funds as they come back. They're great short-term financing. But we're also a larger institutional, so we have access to a lot of credit opportunities.
And Peter, on the development side, construction and development always are a special case with respect to leverage and financing. How do you work across the cycle to make sure that you have the right access to funding as you go through your development cycle?
Yeah, you can only make return by taking a certain measure of risk, right? To state the obvious. And I'm sure there are opportunities now to find great assets in the hotel space or in retail that have been bundled with everything else. And when the markets throw out the baby with the bathwater, it's interesting to find opportunities. We take a different measure of risk. We go down the risk spectrum of from stabilized assets more towards development and redevelopment, but stay squarely within asset classes like multifamily that don't have headwinds. And what we do there is trying to structure risk smartly by taking positions in the middle of the capital stack with a lot of equity subordination, low senior leverage, and putting in contractual agreements with our operators and construction partners in terms of who bears the cost overruns, who is responsible for timely delivery of these projects, and certainly not extending ourselves on the leverage side. So these days we would lend somewhere between 50 and 70% of LTV or LTC, depending if it's an existing project or construction. And we are looking for a double-digit return on that. So that's the space we play in. I promise I'm not cruel to babies, but that's when you find opportunities, when the bathwater and the baby go out together, right? And you catch the baby. And we're finding that in the construction space, because banks have dialed back. Their tier 3 capital ratios have to increase. The Fed told them to dial back, and they're just not lending towards very solid construction projects that may be just a little bit delayed. That's where we find opportunities today.
Peter, quick question for you, if you don't mind me jumping in, is, with everyone searching for yield, construction seems to be one of the few places you can get yield. With the return, of the pandemic, look like it's winding down and hope on the horizon. Have you seen more entrants enter that field? How are you guys kind of viewing that in the new competitive space?
Certainly more entrants, because the yield still exists here and everyone's searching kind of desperately for it. But it does require a certain different approach and a perspective. For instance, you kind of have to be comfortable taking over a construction, right? And your typical debt fund, certainly a bank, would not be comfortable doing that today. We are essentially a developer by history and experience. And if we have to take over a project, which we have done before, either through a foreclosure or basically our construction partner leaves, or we remove them if something bad happens, we're very comfortable taking over that and doing it, finishing it ourselves. I think that's the major hurdle. Otherwise, really, there is no return without risk, obviously.
So another topic that I think is very relevant today, as we've seen the markets improve. When you look back to March, April of last year, a lot of fixed income market participants in particular were caught in an illiquidity squeeze where financing dried up, where the instances of being over leveraged sort of manifested itself. There were lots of illiquid investments that were disgorged into the markets to meet margin calls, et cetera. And I think it, in some respects, brought a halt to the process of over leveraging, but even appear to be safe assets because of liquidity concerns. Has that experience changed your perspective towards the level of financing that you would provide to a particular project? Do you limit your financing to senior debt? Are you comfortable with mezzanine debt? Are you comfortable with preferred equity? What are the considerations that help to determine the overall loan to value or loan to cost that you're comfortable with as organizations? Steve, do you have a view on that, or anybody?
Yeah, I mean, I think for us, I don't think our view has changed. It is somewhat asset specific, right? So I think from a leverage perspective, we're most comfortable in assets that our equity team owns and markets that they own in as well. But in terms of, I think we've always been prudent in the size of our sub debt position compared to the overall loan, right? Like we don't want to sit behind a very large senior loan with a very small mezz. So we're looking to be 15 to 25% of the loan stack. And then just in terms of, back funding, if we are doing whole loans, right? Like we're not in the business of doing mark to market lines. It's just not what we do, right? And I think on our whole loan strategy, it's really more of a special situations and or construction strategy, right? So it's usually assets that are lower or non-cash flowing. So they're not getting great leverage on a line anyway, and we'd look to match term fund them after a closing. But yeah, I don't think anything related to like the pandemic has changed how we've financed our book or looked at it any differently.
Great. Any other thoughts about structure and extent of leverage around assets?
Yeah, Robert, I would say the lesson that we learned here is not so much how much we're going out with our senior piece and leveraging it. It's stayed pretty consistent. We've come down a little bit, but just the quality of your underlying debt, whether you're using warehouse lines or relying on CLO or yes or securitization to get a deal done. Whether like Steve said, there's a mark-to-market provision or margin calls. Those are we were able to get a lot of deals done at that point because of we do use some warehouse lines and subscription lines for our capitalization, but we've got multiple lines with a lot of different relationships, and we've gotten good terms on those, flexibility, and that proved to be a real competitive advantage. And I think a lot of groups that didn't have that, they had to go out of the market. They had to leave a bunch of deals that were midway through diligence because the financing wasn't there. I think it'll be interesting. A lot of those groups that had to leave the market for that period, and really not good for your reputation if they're going to go back to those same structures and or if they're going to change, because that was the biggest disruption that we saw.
I like to be able to say that we're always rational and want to stay very focused, and it's just the market that goes crazy every now and then, right? But really, the key to investing across cycles is to keep some measure of discipline and look at it the same way, regardless of what distractions the markets bring. And today, in particular, it's interesting to contrast or compare to the great financial crisis. We did a number of deals back in 2012 to 15, providing mezzanine construction debt for some high-end luxury projects in New York and San Francisco. And then we stopped in 2015 because we thought the pricing was just getting overextended and the values, the V in LTV didn't make sense to us. We didn't change our 75% threshold in terms of leverage. It's just that the V moved in a way that we couldn't rationalize. Now, turns out we were a little early stopping that. It went on for another 3-4 years. Markets can be irrational a little longer than you would think, but now it's a problem because that V was illusionary. In New York, those condos are never going to sell for the prices that they commanded in 2018. But we are seeing some value where the borrowers are willing to accept the reality of today. And we just closed 2 weeks ago on a condo refinancing that we think makes sense at a value that is 50% below what it used to be. And we're providing a refinancing of basically taking out a loan that was coming due at a 16% return. Who knows how long it will take to sell this luxury condo tower, but at 50% below what it used to be, it seems the V in the LTV is solid. So we're willing to take that bet, and hopefully it won't take too long.
Well, Peter, you bring up an interesting topic of rescue financing and distressed financing. Over the latter half of 2020, there was a ton of capital that was raised in the context of distressed debt financing, some real estate oriented, some more generally oriented. There were tens of billions of dollars of capital raised. And I think notwithstanding the example that you just cited, which sounds really attractive, the number of opportunities to provide rescue financing or distressed investing have been somewhat limited. Maybe more will manifest itself going forward. Does anybody have a view on the future landscape of opportunities in that context?
I mean, I'll go just to give some recent experience I've seen. So we are targeting certain rescue capital opportunities and note acquisitions. And some of the stuff we've targeted has been in the hospitality space. And it's really been twofold, right? We've targeted rescue capital opportunities on what we believe are hotel assets in irreplaceable locations that will come back, right? To what Ted said earlier. Where it's just a liquidity event and someone maybe they need pref equity to get them to year 3, right? And they have a CMBS loan and they need to do a mod and they need new cash equity to do it. On the flip side, we have looked at some hotel note acquisitions where we don't believe the hotel has a future. And we're looking at buying certain notes really for land value, right? Where we would basically knock down the hotel and convert it to another use, and or potentially, depending on the hotel, convert it to multifamily. But like in terms of it hasn't been a lot. We've seen certain opportunities from special servicers. We've seen a few from regional debt funds, really specific to the coastal markets, New York and California. And that's really it. So I think in the coming months, we will see some larger sub-performing portfolios come out from some banks and life cos. I think we will see special servicers sell assets either as notes or foreclosures, depending on the jurisdiction. But it really, we haven't seen, I'm curious to get the other panel's view, but we haven't seen much.
Yeah, I would say I would echo that sentiment. We're not we didn't set up a distressed fund, but that's kind of a lot of what we're doing is business plans from a bridge perspective that were on track and now have gotten delayed. And we think they're going to come back. Hospitality is the most obvious one. But I think the play with this distress is otherwise solid assets that were just unlucky when it came to this pandemic. And so, but what you're seeing is a lot, for example, in the retail side, right? There's a lot of distress there, and it was affected by the pandemic, but the pandemic maybe just accelerated a trend that was already there. And there's not really a catalyst to get that retail asset back to performing. I mean, with a lot of the retail out there, you just need a massive change in your basis, maybe to convert it to a warehouse or something like logistics facility. And we're just not there yet. So maybe you see that in the long run, but you really have to be creative and have a good catalyst with retail. Maybe there's something there on office, but my guess, and this is just conjecture from the deal flow that we see, is that there's enough dry powder out there that anything that's halfway decent is not going to get to a distressed level. I mean, the note acquisition activity we see is, mostly at par, and it's not that compelling unless there's something really wrong with the asset, and it's just there's not really a compelling story to get out of it. I mean, Steve had an interesting thought with buying it for the land value, but that's really a basis play. You need a huge destruction of value to get in at the basis where that makes sense.
Last thing to add is I think the only distress and real opportunity we saw was, dislocation of the mortgage-backed securities early on in the pandemic, kind of March of last year, that, folks that played and had portfolios in those spaces were able to, create opportunity and make a lot of money. On the asset side, echo, Steve and Ted is, there were some really bad assets and really bad actors, but for the most part, as the flood of capital came back into all the sectors, bailed a lot of folks out.
It's an interesting bifurcation of the markets because notwithstanding all the capital that flowed to distressed funds, it's, as you all have pointed out, it's really hard to deploy. Having said that, there are plenty of opportunities to deploy in the regular way real estate finance markets and earn a good return, as opposed to having your capital be sitting on the sidelines. So you may see you may see a melding of those markets over time, or of those strategies over time. Edward, from your perspective, when you finance multifamily in particular, are you finding that the recent increase in base interest rates in treasuries have impacted prices and impacted the level of financing that you're prepared to commit to?
I think the increase in the treasury has, if you're looking at the folks that use that kind of the fixed rate, let's just say the agencies, I don't think they've dramatically decreased their spreads yet. So the overall rate is up, which, does create a little more opportunity for a sub debt piece based on lower leverage going on acquisition. We are seeing that. Now, the second part of your question is, how do we take into account the value? And, frankly, we're seeing a lot of capital looking to buy multifamily and frankly accept lower returns than they might have, 1, 2, 3 months ago. So we're focusing on the V very carefully, picking specific markets, picking specific corners, looking at growth that we can understand that will support that increase in value to a point that we feel comfortable. I think the increase in value has been broad brush. It's major markets, secondary markets, it's even tertiary markets. You kind of feel like that low cap rate applies whether you're in Huntsville, Alabama, or Raleigh, Durham, which you wouldn't have thought before. Both are good markets; they have their strengths, but you wouldn't have seen that before. So we're really trying to get very specific on the markets, the submarkets, the corners, and the people to help us understand that. Do we feel comfortable at a leverage point at that higher valuation, or frankly, we just pass?
Maybe in that context, and it would be great to hear from all on this, your comment about compressing cap rates, about compressing returns for equity investors. There's been, in some respects, a convergence and a decrease in the delta between the returns to the lender and the returns to the equity holder. Do you all have views on what that spread is, and whether that makes debt relatively more or less attractive than an equity investment?
Not to hold the floor, I'll just lead us off. We focus on our last dollar and is our risk-adjusted return appropriate for where we're investing. We also have the option to buy assets directly. So, I think it's a matter of what do you believe to get the equity return? We see in some of our sub-debt investments that, we believe the equity is a little more aggressive than we are. We're still well protected. We still like the asset. We still think they'll do okay. But it really can depend. It really depends on how you believe the growth in that market or the stability of that market will play through. But in general, broad brush, if there's lower returns being accepted by the equity, the debt returns will probably get pinched.
Yeah, I mean, we're sharing, we share deal flow across the platform, right? So our JV equity guys are sending deals to us and we're sending deals to them, right? And we're looking at individual assets we like and where we think we could generate excess returns at a certain point in the cap stack for our investors, right? So the other thing I'll mention, just from the JV equity perspective to the credit perspective, is current income to your investors, right? So there's an advantage right now to doing, and I'll just use pref as above an agency loan as an example, right? You may be able to generate a higher current return to your investors than you would otherwise on a JV equity investment for that same deal, right? Depending on how the cap stack is structured.
That's an interesting relationship.
As a construction lender, navigating the return to equity and the return to our debt is always a tricky question, because we don't want to lend at higher rates to someone who may be over optimistic and actually not achieve their equity targets, because they will lose the motivation to finish it at some point. If we see a project that just doesn't pencil for the developer, why would we lend on it, even if they are, estimating that they can do it? On the other hand, we need to be able to extract, a proportionate amount of return to our risk. So finding that relatively narrow band of equity return that we agree with, but maybe too optimistic on a little bit, and extracting that little bit of optimism from the equity investor, that's where we make our return. On sort of another aspect of this, I just had to look at the comparative yields of what's happened over the last 10 years between other asset classes and real estate, and just kind of to maybe provide a relative picture. 10-year treasuries, the 10-year average was over 2% over the last 10 years. Today it's 1.3, so down more than a third. Junk bonds down 40% in terms of yield. People are accepting 4% return for junk bonds, down from 7. S&P earnings in terms of dividend down 30%. People used to get 5% S&P yield. Now they get 2.5. Real estate cap rates actually not changing that much. On average, they were 6.5% over the last decade. They're kind of 5.5 to 6 today. So down maybe 5%, maybe a little more. To me, that says, relatively speaking, that wall of money that was created by the Fed over the last couple of years went to other spaces. It went to Bitcoin, it went to Tesla, it went to SPACs. I mean, those numbers, I can't comprehend that. When you pay more for something that only has cash in the bank, but you pay a premium for it. To me, the cash flow from a multifamily project, even if it compressed from 5.5 to 4.8, is still, relatively more interesting.
So you're seeing a lot of relative value in real estate, which I think is a theme that is driving a pretty significant amount of capital to flow to real estate. I know we do a lot of work in terms of understanding institutional preferences and allocations to real assets, and within real assets to real estate have been going up consistently year over year over year, and continue to increase as time goes on, notwithstanding the somewhat compressing cap rates that we've seen.
Yeah, but absolute returns are not as good anymore. We all retreat to the relative world.
So I know some on the panel have a broader than US investment thesis. They invest across Latin America in some cases, and potentially in Europe and elsewhere. How do you judge the relative risks and required returns for a Latin American investment versus a US investment? Are there appropriate differentials in terms of returns to adjust for geographic and political and other risk? And maybe as an aside, where is the political risk higher?
I'm not sure who invests internationally on the panel, but we do invest in Latin America, and we really strictly have to put on a local hat, because these days it's very difficult to assess the geopolitical risk, and frankly, the currency has been our biggest headache. As we invest locally and have local teams in Latin America, really look at it just in comparison to that market, because cross-market comparisons are very, very difficult. While it would seem very compelling today because the currencies are so battered in Latin America, I'm not a currency prognosticator, so I can only tell you that you can get double-digit yield there still, on Class A product, main and main, beautiful assets, great tenant credit. That doesn't bring a lot of comfort to a pension plan that has to feed its liabilities with dollar returns if the currencies whack out by 30%.
Fair comment. So as I want to leave 10 minutes or so for questions. As we wrap up this part of the panel, it would be great to go around and if people would feel comfortable, providing what they see as their best set of opportunities or best opportunity and focus in the market today, that would be great to give our listeners some indication of where you see the greatest opportunity. I'm going to go by way of how people are arrayed on the screen. Edward, starting maybe with you in the top left.
Yeah, perfect. Happy to share. Thank you. We're seeing a lot of opportunities in the market. I'd say the ones that are kind of getting the most traction are, selective recaps on, again, we do mostly multifamily, either partners wanting to exit or unlock equity that's been in the project, either be via, a slightly stabilized development or just a long-term hold. Rates, even though the treasury's ticked up, long-term rates are still very attractive. So we see that as a great opportunity, and we have long-term appropriately priced capital that can really play well in that space. Acquisitions heating back up, yeah, that's an opportunity. And then, sorry, Peter, but we're active in the construction space as well. We're seeing a lot more activity in that space. We have moderately priced, moderate leverage capital, which is, we also have higher leverage, higher rate capital. The moderate rate leverage capital is getting much more interest right now. I think people still have some scars from the last 12 months. They're concerned about over-levering. They're concerned about the forward growth rates. So that's been a really great avenue for us recently.
Thank you. Steve?
I think we'll be focused on some construction opportunities, both stretch senior and sub debt. We're seeing some very interesting opportunities on the non-cash flowing or low cash flowing bridge loan space, where a lot of the CLO issuers aren't targeting, specifically in the middle market there. And then, I think selectively we will see more rescue capital opportunities just for liquidity events across asset types. So I think we'll be focused on that. And again, that could be in a lot of forms for us. It could be as pref, it could be as, JV equity, with some sort of co-GP, opportunity. So, we'll play on all of that. And then we may see note acquisitions. We are geared up to buy distressed notes in certain markets. So we'll see if we get any of them.
Terrific. Ted?
Yeah, I'd say near term, we're looking a lot at hospitality because I think that's its time has come. And then a longer term, the next 12 to 24 months, I'd love to develop an office thesis that makes sense, though, that continues to be difficult. And then another thing we're doing a lot of is kind of repositioning where the current type is not the highest and best use. So we've done several hotel to multifamily conversions. We recently did a sort of an industrial co-working, these new concepts that are maybe better at, a little bit cutting edge, but have a lot of tailwinds, makes a lot of sense. We've done some daycares, converted them to Montessori schools. So we don't do ground up construction. So this is the kind of stuff that's our bread and butter. And when it's repeatable, we can do it with the same sponsor over and over. That's where we've had a lot of luck and continue to try to do that.
Thank you. Peter?
I wish we had sort of more expertise in hospitality and retail these days, because I'm sure there are some great babies in that bathtub, to continue my weird analogy, but we stick to our knitting. And so within residential, we are geared up for the distress. We've done all but one deal so far. We'll see how that goes. We are seeing a lot of opportunity to finance home building operations because the demand has been really strong in that space. We're not producing enough units, so we're providing preferred equity and mezzanine financing for home builders who have sold their units. They pre-sold it and have to build it within the next 12 months because they have buyers showing up at their sales offices. But when they go to the bank is either not lending against construction or is very slow. So we're stepping in at double-digit rates with preferred equity or mezzanine capital to just finish construction on these communities. that's been really our bread and butter in the last year or so, and we'll continue doing that. We used to do a lot of equity for home building, but these days our home building partners are asking us more for mezzanine or preferred to fill in the capital gap.
I think some of the comments have referenced the rebound in the hospitality industry, and it's probably an early indicator of the of hopefully the reopening of the U.S. economy. As five, including myself, as five real estate firms represented on this panel, the question surrounding office and office reopenings is a little more complicated. You know, what's going to happen near term, what's going to be a long-term balance between de-densification, reoccupying, remote working, et cetera. Just as an informal survey, it seems that real estate companies are leading the charge to get back into the office for a variety of reasons, maybe some good, some bad. What are your all's perspectives on working from home versus office collaboration at this point? You know, before we take any questions that may be offered. Edward?
Yeah, you know, we've been working from home. We're probably going to phase back in the near term. We have a wide open floor plate in our office, so it was not pandemic friendly. But you know, and we have an active office strategy. I think the world has changed. You know, we're believers that, you know, potentially a 3-day work week in the office probably will become normal with 2 days remote. That the style of office will be different. That, you know, massive elevator cores, great central lobbies that you know, present a lot of commingling between the various floors and tenants, maybe something that's a little bit of the past. That it's really identifying what the tenants want, what the tenants need, and what the tenants feel comfortable with will change the office environment. So, you know, office will still be a thing, absolutely. But I think we need to look at the product that we're offering and differentiate or change it a little bit for this kind of post-pandemic mindset.
Will there be a need for more or less office, do you think?
I think in the near term a contraction, but it will stay and it will stabilize and then continue to expand as the economy expands long term.
Steve, what's been your experience?
So we have offices in New York, Austin, Texas, and Denver. You could probably guess which ones are mostly open, but yeah, I mean they're open to whatever the state guidelines allow. So Texas is open, Denver's open. New York, we are selectively going in. You know what EJ said, just about big floor plate, you know, high rise office just being open so far. You know, it just isn't there. I mean, I think the occupancy in our office building in Manhattan is about 10% on any given day. You know, I think the need for, I think we'll probably have some, you know, flexible working hours, right, or days, but we'll definitely keep all three of our offices. And I think what we'll probably see out of larger companies, just from some of the office owners I've talked to in New York, is more regional, you know, regional planning by larger companies, right? So they're going to have maybe the same amount of office space in that large metro. It's just not going to be in one building in Midtown Manhattan. So I don't know. I think there'll be a slight decrease in office space use, but I think you're probably just going to see some more regional office setups.
Peter?
Agree with that. I think you probably will need more office in places where people are moving in the Sun Belt, particularly places like Denver, Charlotte, Phoenix that are growing, you know, 2-3% a year, and probably quite a lot less in New York and probably San Francisco. I read a very worrisome statistic just yesterday in the journal in terms of card swipes. When you enter the office in New York, 12% of people are back. That is very scary to me and starting to feel like it's not just the pandemic. We've been back in the office since the summer. It's, you know, incrementally more annoying to travel and all of that, but At this point, it doesn't seem like just the pandemic causing this. Turns out people don't love sitting in cubicles in a 1960s office building deep inside under fluorescent light. It's actually not so bad to work from home. And that portends quite badly for some of the outdated stuff in what used to be the Class A office districts. I think it's not as bad for a creative office in Nashville, where people will love to go to enjoy the camaraderie and the creative spirit that can enhance. But it's a bad news for some of the formerly Class A office landlords in New York and San Francisco. No question in my mind.
It's a good comment. Ted?
Yeah, I think a lot of great stuff's already been said, and I'd echo a lot of what Peter said. Just a little bit more color. Whereas we like hospitality because I think people really want to get out and travel again. They've just been prevented from it. I'm not very convinced that people are like dying to get back into the office. So people found that they're very effective. They like the flexibility, the lack of commute. And I think there's going to be more of a push from sort of the heads of companies and bosses to get back into the office, and not so much from employees. So I think that's more of a macro thesis, and I think Peter's exactly right on. You're going to have to make it somewhere that people want to go as an amenity, because it's like you can work very well from home. And so the question is, why am I here? And so I think that's going to be a longer term, much past this pandemic, as far as how that plays out and the fundamentals of office valuations.
I believe that, Bob, we have you.
Sorry, yes, I got a note that I had an unstable internet connection for a moment, which is
That's okay. No problem.
one of the reasons why an office environment is sometimes better than a home environment. But I know we're, Marina, coming up to the top of the hour. I don't know if there are any questions that any of the audience might have or want to pose. Apologies for taking a little more time than anticipated for the dialogue. Are there any questions?
There don't seem to be any questions. Everyone listening in, please feel free to submit any questions within the next minute if you have any. But if nothing comes up right now, feel free to email me, and then I'll provide the questions directly to the panel right after the event.
Well, perhaps in the absence of questions, I could take the opportunity to say thank you, Marina, first to you and iGlobal for organizing this. Secondly, to the panel participants, thank you. We're all in the same industry. I learn things every day, and learned a lot today from the perspectives that you all had to offer, and so most appreciated. I hope the audience found this to be illuminating of what some of the areas of focus are from the real estate debt perspective, what some of the areas of opportunity are, and certainly I believe everybody came away with a lot of confidence that the four firms represented here have a measured and practiced way of accessing those opportunities. So thank you all for sharing your perspective on the markets with the assembled group.
Thank you as well. Thank you for joining this discussion, for the panel and the attendees. A copy of this recording will be made available. You will receive an email with a link to download and save the recording, or you can access it from our website. Again, we have several other experiences scheduled for the next few weeks and most likely months, and we encourage everyone to join us for those as well. Again, thank you so much to our panel, and until next time, stay safe and healthy, and have a great rest of your day from the whole iGlobal Forum team. Thank you all.
Thank you.
Thank you.
Thank you.